first, I believe that CPAs have a responsibility to their clients to point them in the direction of good financial advisors. People are more confused than ever. They've been through very difficult markets. They've lost massive amounts of money over the last 10 years in bad investments. And so I believe that CPAs should proactively send their clients towards an advisor that can help them with that. A big part of that is the failure of buy and hold. Most advisors and a lot of CPAs follow a strategy of buy and hold, which is just you buy something and then you just wait for it to go up. Well, if you bought something 10 or 12 years ago, you're still waiting for it to go up. And in my opinion, that's a complete failure of an investment strategy if you have to wait that long to hope it all works out. So I believe there's better strategies. I believe that we follow an active strategy. We've followed active strategies for the last 23 years. There used to be a debate, which is better, active strategies or a passive strategy like buy and hold. I think the argument is non-existent anymore. If you look at our performance numbers over the last 11 and a half years, essentially our portfolios are up from January of 1998 to September 30th of 2009. We're up about 330% versus 33% for a buy and hold S&P index strategy. So we've outperformed it 10 times over the last 11 and a half years. For me, I think that's something that CPA should be taking a serious look at. Right now, there's a huge opportunity for investors who have capital loss carry forwards. Some of the CPAs I've talked to are telling me that as they're going through their higher net worth client portfolios, they're seeing massive amounts of losses and these capital loss carry forwards. And I mean, they're from real estate losses, they're from stock market losses, they're from bad loans that they've made, they're from investors who have tried to do hard money loans and lost money, they're from business ventures that have failed. The bottom line is a lot of clients are sitting with these huge capital loss carry forwards sitting on their balance sheet and their tax return. And unless they invest appropriately, those are just going to continue to sit there. And the type of strategy that we follow here at Paragon, which is an active strategy, is such that all of the earnings that we generate usually directly offset those capital loss carry forwards. So if you've got a client that's got a capital loss carry forward of a couple $100,000 or $500,000 or just some amount, essentially, if they invest using our strategies over the next years, as we have gains, those gains will directly be offset by the capital loss carry forwards. So in essence, the earnings that they'll receive will be tax-free earnings. So it's a way to have an equity account that you don't pay any taxes on up until the point that your capital loss carry forwards are used up. So, and most advisor strategies don't benefit those capital loss carry forwards. If you're just buying straight mutual funds, they're not necessarily going to be able to offset those. If you're just buying straight stocks, depending on how you implement the strategy, you may or may not be able to use those. But the strategy that we follow directly impacts those. The capital loss carry forwards offset should get your attention because we're one of the few firms that the way that we invest is designed to directly benefit from that. But in addition to that, if I were selecting an advisor and I were a CPA, I'd want to make sure that I was working with a fiduciary advisor. A fiduciary advisor has a legal obligation to act in your client's best interest. And because of that, you increase the odds for success significantly. So number one, I'd work with a fiduciary advisor. Number two, I look at the experience of the advisor. Has he been doing this for 5 years, 10 years, 15 years, 20 years? How long has he been investing? Because the longer that he's invested, the more experience he's got. And you're going to pay similar type costs, so you may as well go with someone who's got a lot of experience. because that's what you're paying for. Track record is extremely important. Most advisors don't post their track record. The majority of advisors don't have a track record. If you look at the way their clients are invested, they're all invested in different things. So they can't post a track record. At Paragon, we post our track record monthly on the internet, and it's there. You can see it for as long as we've been in business, and so that's available. And a track record is so important because that's the only way you can really compare how different advisors have done. In the final analysis, that's what really matters, is what they've done, what returns have they gotten, and how much risk have they taken to generate those returns. Also, are there any conflicts of interest? If you're working with an advisor who is commission-based, then they're selling products, and those products are generating commissions. Those products also have surrender charges. The fact that the advisor gets to pick the commission that he receives for the product he sells creates an instant conflict of interest. As a CPA, you'd want to avoid those kinds of conflicts of interest. Finally, you would want to have your funds custodied at some place where they're completely secure. For example, here at Paragon, we custody our clients' funds at Charles Schwab. That gives them complete protection against any kind of fraud. And essentially, each one of those points I mentioned, those are all at Paragon. Those are all part of the way that those are all part of our identity. You know, we're fiduciaries. We've got over 20 years of experience. We've got a stellar track record that's verified, and we don't have conflicts of interest. We don't sell commission products, and we custody it at Charles Schwab, which is very secure. So those are all, if you're looking for an advisor, those are all things I'd be looking at. We work with CPAs on several levels. We've got some CPAs who are primarily focused on traditional CPA work and refer their clients to us because they like what we do and they think it's a perfect fit. And so with those CPAs, we just work on a referral type basis. We've got other CPA firms that we work more on a partnership basis with. Those firms are more involved and want to be more involved as far as counseling the client, working with the client alongside of us where we're managing the money for the client. And in those we have some kind of a fee-sharing arrangement. And that fee-sharing arrangement is just based on how much work they're putting in versus how much work we're putting in. We have different arrangements depending on the level of work that's being put in. So we work on all levels, from a straight referral basis to a more of a partnership type basis. If this sounds like something that you're interested in, simply give us a call and we'll discuss the possibilities of working together.